Hey there, this is Leo, and on this channel we're all about finance and restructuring. Today's video is a general introduction to restructuring. Why does restructuring matter in today's complex economic environment? How do crises unfold across different stages? And what does a restructuring concept have to deliver to ensure a sustainable turnaround? Let's get started. Why restructuring matters? Because crisis nowadays is no longer an exception. It's the new operating condition under which all companies have to operate. Firstly, we've been seeing an economic volatility. We have seen high levels of inflation leading to an uprise of interest rates across all jurisdictions. We have digital transformation with AI being at the forefront, putting pressure on companies to rapidly adapt to these changes. We do see an increased and elevated levels of market competition that exacerbates the need to transform and to be able to keep up in the market. We have requirements from ESG and sustainability, mostly affecting companies from regulatory changes. And of course, we have a persistent geopolitical uncertainty from existing conflicts, but also potentially new arising conflicts. And lastly, leverage. We are basically in an environment where companies and also governments have been leveraging over decades. Companies, especially following financial crisis of 2007, were used to low interest rate and, let's say, eased refinancing condition. This has changed now. Now we see big refinancing waves at higher interest rates, but these waves now occur at times of higher volatility, transformational need, and increased competitive levels in the market. So it's not just base rate increases from central bank, but it's also from higher uncertainty that is being priced. And many companies that now see profitability eroding and that have to make new investments to remain competitive now face this issue that they don't get the refinancing and thus have to go through a restructuring process. Macroeconomic pressure directly translates into companies' financial. If we think of it of a balance sheet view, these drivers in the markets, they affect equity and cash by eroding the equity when companies' profitability decreases, and cumulative losses affect the equity trajectory. And on the other hand, when the company's cash flow is even negative, we see a cash burn on the asset side. And those two key financial impacts that we see on companies, the cash burn and the equity erosion, can lead to a significant deterioration in the company's financial situation and thus forcing the company to implement a restructuring process. So, how do these crises unfold? It doesn't just happen as a one-time event. I mean, sometimes there may be these shocks in the market like COVID, and then out of a sudden, something changes and we have a big crisis affecting companies rapidly. But usually it's like a long-lasting progress going over several years where we see crises unfold. It often follows a predictable pattern. For instance, leadership failures in the beginning. We see management maybe doing questionable acquisitions or conflict with key stakeholders. If we think, for instance, of Volkswagen when they had issues with key suppliers in the past. And usually this is also followed then by a lack of strategy, innovation, and investment. Companies that do not have a clear way forward on how to adapt to a challenged macro environment, that have no clear target picture on who they want to be in the future. And this also sparks structural issues. Some companies, they have benefited from a strong cash flow generation in the past, but they have now built up inefficient organizational structures that now have a detrimental impact on the cost base. This usually leads to complexity, and if we do not have the innovative power for our products to thrive in the market, we have an underutilization and a decline in market share. We see these companies then facing significant sales drops and an underutilization of their fixed cost base. And this eventually leads to significant decline in profitability, high levels of uncertainties leading to employee fluctuations, and potentially even liquidity issues that lead the company in a situation where they have to delay payments and also put their debt service at risk. We've said before, okay, we live in a very highly over-indebted economy. Now we see companies with liquidity issues breaching financial covenants and not being able to make their full debt service, like interest and redemption payments on the existing debt. If we were to cluster those a little bit more, we can say there are different levels of a crisis. It starts with like a stakeholder crisis, where it's just maybe just one specific issue with a customer or supplier. It can then end up in like a strategic crisis. We say, okay, this company doesn't have a clear way forward. It doesn't make the investments needed to compete in the long run. This translates into a product and sales crisis because the products will not be competitive in the future, or the cost structure will be inefficient and thus the pricing too high. It will lead to a profitability crisis at some point because the P&L is detrimentally affected by a decline in market share and the sales drop, and then ultimately affecting the company's cash on balance sheet due to a significant cash burn arising from the deterioration in profitability. And this, if not stopped and restructured, eventually leads to the insolvency of the company. Let's say the further we step here in this process, the less room we have to maneuver and the higher is the urgency to act. It would be the best for the company to proactively engage into a restructuring process at the level of a strategy crisis. But usually companies are not aware of this or do initiate these processes too slowly or too late. So they might end up in a liquidity crisis when it's just shortly before an in-court restructuring process of an insolvency. So first phases, let's say they are a hindrance to development, but they don't threaten the existence. The product sales and profitability crisis already endangers the existence because that already erodes the equity. And then the liquidity crisis, insolvency, this is an imminent threat to the survival. And now let's differentiate when we talk about consulting in particular. Strategy consulting, operations consulting, and restructuring consulting. Typically, when we talk about restructuring, we're talking about companies that find themselves in a profitability and liquidity crisis, while strategic consulting is more broadly positioned in the first phases of the stages of a crisis, while the operations consulting is rather operating in a product-related and manufacturing ops-oriented area. So typically when we talk about restructuring here, we would say this is in the profitability and liquidity crisis, while of course we always have to keep in mind restructuring must deliver a new strategic target picture and way forward for the company as a whole. Otherwise, it will not be successful in the long run if only the short-term crisis is being resolved. So when we talk about the restructuring consulting on the right side, we make a distinction between in-court and out-of-court restructuring, which is rather straightforward. In-court restructuring refers to a restructuring process from an insolvency process. That obviously is very different from doing it out of court to prevent insolvency. So after understanding now why restructuring matters and how the crisis unfold, we now look at what a restructuring concept has to deliver to address this situation. And first of all, it is crucial that this restructuring process creates an alignment among all the stakeholders involved. This may sound generic, but in restructuring, you have a very, very complex stakeholder environment. Because on the one hand, you have the company in distress. The company in distress has its managers and its employees who oftentimes find themselves in a crisis for the very first time. So this is a very challenging situation that doesn't only affect them in a job kind of way, but also in terms of their private life. When we think of the concessions they might need to make in terms of salary, in terms of utilization and so forth. Besides the company itself, we have, of course, the customers and the suppliers. Both of them face high levels of uncertainty in a crisis. Like they see this company maybe delaying payments, not delivering the quality. They have uncertainty on whether they should provide credit in terms of like payment targets, for instance, or prepayments from customers. Obviously, the financiers, the equity holders, the owners, and the debt holders will be affected by this restructuring. Usually, both of them need to make concessions and need to support the restructuring concept that will be developed. Financiers might have to accept later on a haircut on their existing debt, or equity might have to accept that they lose a certain stake of ownership. And then there are other special stakeholders such as credit risk insurers, for instance, about which we will get back to in more details at a later stage. The restructuring concept now has to address all these stakeholder interests in this company and has to answer two key questions. First of all, it's about transparency. The stakeholders, especially the financiers, the debt holders, they need to understand what is the current status quo, the financing need, what is the current situation, at what stage of the crisis, which we had discussed before, does this company find itself. And what is the financing need that arises if we don't do anything, if we just let it go? And then secondly, based upon that, on the do nothing scenario, we need to evolve a target picture of the restructured company and then create measures to achieve the target pictures and tackle all the causes of crisis to sustainably and holistically restructure the company. And this will be reflected in a robust financial plan over several years that shows the financial trajectory of the restructuring. Basically, this process is undergoing several steps. First of all, we analyze the status quo, transparency on the actual situation. We then evolve the concept, the target picture, and the measures needed for the company to become competitive again and to ensure sufficient financing. This is reflected in a financial plan. That is then the basis for the negotiations between especially the lenders who are in the lead in the situations. And this will eventually lead into an agreement between those lenders. It will send this company on a restructuring path to execute this concept in the subsequent years. Speaking a little bit about the financials, if we think of the do nothing scenario, the understanding the status quo, when we think of this company in terms of liquidity, there's time, there's liquidity over time on a monthly basis. A company thrives in the market if it generates positive cash flows and if it thus increases its liquidity, its shareholder value, and also the value obviously generated for other stakeholders. It has to generate cash. Companies who find themselves in distress, they drain their cash and eventually go below zero, meaning they have less money than they need to cover their cost. So if we think of this here, in a situation like here, we are in June 25 Act, for instance. And then we'd be starting to make a plan that outlines what is the do nothing. If we don't change anything and we just let the cash flow burn, then what would arise? We would see a financing need by June 26 of minus 80 here. This is the financing need that arises in the given planning horizon. So this would just be required to push this company back to zero. Why, for instance, could it be the fact that this jumps so deeply here? Because maybe there's a big investment we needed to make. Or maybe there's a big redemption payment because we have to redeem a certain financing, like a bond or bank financing. We can say there's a huge financing need. And this financing need may even be larger because usually you wouldn't want a company just to have a liquidity of zero. This is not stable. A company needs a certain, let's say, working liquidity to be able to cover up normal operating swings. And thus, we wouldn't say it's just 80 to go to zero, but we would say, maybe it's a bit more than that. It's 95 actually, in this simplified example. So what a restructuring concept now has to deliver, it develops a target picture and measures to achieve this target picture. And these measures eventually have to lead to a positive cash generation again. This company has to become positive again, or it has no reason to keep in the market. Otherwise, it can file for insolvency. A company that is not able to sustainably generate cash flows has no right to exist in the long run, basically. We're not talking about non-profit organizations here, of course. We're talking about companies that survive by generating profits. Here in this simplified example, a restructuring concept has been evolved that will eliminate the cash burn and that will elevate this curve, the blue curve, to the green curve, basically. All the measures slowly kicking off, taking some time, and then at some point showing huge restructuring gains in the long run so that liquidity of at least 15 by the end of this planning horizon can be achieved. Just broadly speaking about this restructuring concept, we won't go into too many details at this stage. It's a holistic mix of restructuring measures. It's a target picture that's at the top. Where do we want to be? What products do we want to offer? In which markets? What is our strategy? In which businesses do we want to be in? Which businesses do we not need in the future anymore? And derived from that, we have structural measures to take. For instance, do we sell a subsidiary? Do we discontinue certain products that are not profitable anymore? And then we have profitability and operational measures. Measures that increase our revenue, for instance, or that improve our cost base in the existing businesses, that streamline our processes, that make us more efficient, that improve our transparency in terms of financial control. And then, of course, we have financial measures. This is usually about the capital structure, like optimizing the capital structure to make it bearable again. Usually, these restructuring targets, they are over-indebted. or at least have a lot of debt on their balance sheet, which they cannot serve with the cash flow they generate. Even when you do structural measures and profitability and operational measures, most of the times you will have some games being played on the equity and liability side of the balance sheet to resolve with a capital structure that the company can deal with. And that is also attractive again for other financiers to invest into this company again. So looking back on our balance sheet, where do we find these areas again? On the asset side, we can say fix the business. That's about fixing the operations, improving profitability, generating cash from working capital, for instance. On the liability side, that's about fixing the financing. And fixing structure and strategy obviously affects the whole balance sheet. So translating this into what we've seen before, operational restructuring, profitability measures, that affects mostly the asset side of the balance sheet. Financial and debt restructuring affects the relationship between equity and debt, capital structure of the company, while strategic restructuring and the defined target picture has an impact on the grand scheme of things. Right, so that was our first introduction to restructuring. You've seen there are so many areas in restructuring where we can dive a little deeper, and that makes this topic so complex and interesting at the same time. So stay tuned for the next videos to come. There's definitely much more content to come, and thanks for watching.